Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the XLE. That is an ETF that tracks the energy sector. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, I have a chart of the S&P 500 index up, and before I pass it over to you, I just want to talk a little bit about a couple of charts. So last week we had an interesting week in that we had the Fed talking and had a Fed meeting last week, and so the markets have been meandering higher, for lack of a better verb. And when the Fed spoke, we actually had a big downturn after setting a new high. So we didn't break out too hard to the upside, but we did have a little bit of a downturn, but we took it back right away. And before you know it, we broke out to another new high, and now we've meandered once again, even higher ever since the Fed meeting. So overall, markets are kind of slow. We saw VIX is down around the 16% level overall. I'll talk more about that a little bit later. But the markets just they don't want to go down, but they don't want to go up. And it would be really nice to get one big green candle just to show a little bit more certainty in the marketplace overall. Now, with the NASDAQ has been leading the way recently, and we saw the NASDAQ set a new high before the S&P 500 index did. But the other chart that I want to show before I pass it over to you is the IWM, which is the Russell 2000 index that tracks the small caps. It's had a long channel. We're going all the way back to February in this chart. This is a daily chart. And I kind of grayed out the channel here. And we see that once again, we're coming up towards a new high, even in the Russell 2000 index or the small cap. And it would be real interesting if we can get back to that high once again and break out. Now, this is the level I just want to make note of. If every time that we bump up against the new high or come to the higher end of the range and attempt to break out, the more likelihood that we will eventually break out. So we came close to a couple of times here. 1, 2, we get back up here again. It's just an interesting point that you want to make note of overall. So with that said, let's go back to you and let's talk a little bit about what's going on in the marketplace right
now. All right, Brian. Well, I think you hit all the high points. I think your tidbits were a little more interesting than everything I'm about to say, because you're right. We're back to the June doldrums after the S&P's quick 2% sell-off earlier this month around the Fed meeting. It's been largely a technical market too, which you alluded to. What do I mean by that? Well, we're all watching the moving averages, and it seems like the S&P is kind of bumping in between them. I'll point out the 50-day moving average. I've been watching that as a good clue on where the market could go next. Why? Well, the 50-day has proven to be quite the floor for the market. In fact, the S&P hasn't closed. It's below its 50-day for 2 straight days in nearly 8 months, which seems like a long time, and historically it is. It's the longest such streak going back to January 1996. So, we're stalling a little at these levels, Brian. There's not much volume. There's not a ton of good news out there. And investors are still anxious as we move out of this high growth phase into a rate that's a little more normal. So we're in a holding pattern, like you said. There's not a lot of impetus to go higher, but there's not a lot of drive to go lower as well. One thing I will point out, though, breadth, or the number of stocks moving up versus down each day, is getting progressively worse, and Wall Street is kind of picking up on that. So that's a negative trend we're watching. Generally, you want to see lots of stocks lifting the market higher instead of a few stocks lifting the market higher. So we're definitely keeping an eye on that. We're also seeing a resurgence in growth stocks and big tech, which is pretty interesting because they haven't, led the market for a few months now. In fact, I'll throw out too, Facebook became a $1 trillion company yesterday. And it looks like the worry over big tech regulation is receding from the market for now. So overall, the market does seem to be backing off from the inflation trade. Otherwise we would see other stocks doing well instead of growth stocks. But we don't think the inflation speculation is quite over yet, so that could prove temporary. And speaking of inflation, we do have some economic data on the docket this week, including the June jobs report on Friday. That's going to be the most interesting report this week, probably the most interesting thing that's going to happen in the next few weeks, knock on wood. And it may or may not make a splash in the market. So that's the next event we're watching for. Otherwise, it's same old boring market. All right, so that's the rundown of what I'm seeing in markets, Brian. I'm too fast for my own good. Tell us what you're seeing in the VIX.
All right, so here is my VIX watch list that I'm highlighting right now. And you will see, if we look at the VIX, as I mentioned, it's down around the 16 level. So we're getting back to more normal since the pandemic, right? 16 level is a very viable volatility prior to the pandemic days. But the futures contracts still remain elevated. It's nice to see the August future, which I'm highlighting right now, below the 20 level. But if we get out to September and October, the VIX is still up around 20 and 21% relatively in those two futures contracts, just showing that there's still some nervousness in the marketplace, especially going out to the end of this year. September and October are overall usually more volatile months in the marketplace, just in general. So we're still struggling with getting the futures contracts down near where the actual spot index is at. Now, with that said, it has came down precipitously relative, and it's a little bit, there's less dichotomy between the futures contracts and where the actual VIX index is at. So overall, that's a good thing in general. And so moving forward, what we'd like to see is some of the longer term futures contracts actually come down below that 20 level. That 20 level has been a magic number ever since the pandemic. It took forever for the actual VIX index to get below it. So today we're going to talk about energy companies. I'm showing a chart of the XLE. That's the ETF that tracks the energy space. What do you see going forward in the XLE?
Yeah, Brian. Well, let's talk energy stocks. I mean, I mentioned there aren't many surprises in the market. So let's talk about one of the few surprises we've seen this year. All right, so S&P 500 energy stocks, let's talk about them. They've risen 41% this year, by far the best performing sector in the market. I don't think anybody guessed that would happen this year, but it's happening. Why? Well, people are getting out of their houses and crude prices have risen 50% year to date. Because of course, if you want to travel away from your home, you need gas. And I'll throw out too that energy stocks were some of the most beaten up stocks in the early stages of the recovery. So they benefited from the surge in value stocks, value style stocks, and the increased search for opportunity with the market at record highs. You know, simply some people might be taking a flyer on them. Now, to be clear, this is still a very down and out sector. Many big energy names are in rough shape financially, and it's been a tough several years for them. They have a lot to come back from. But earnings in the sector are rebounding quickly, and the increase in crude prices could mean more room for profits. So let's talk securities, because I generally like to talk about why we're picking a fund instead of stocks. I don't study the energy sector in depth, if I'm being honest, and I don't feel great about seeing value in any company over the other. It's a really tough sector to really sort through these days. Plus, the sector has rallied en masse this year. In fact, 17 of the 20 S&P 500 energy stocks have risen 20% or more this year, which is pretty incredible. So for this week, we're looking at a fund called the Energy Select Spider Fund, which is ticker XLE, like Brian said. It's one of the most heavily traded energy ETFs on the market, and it has a healthy options market too, which you need for stock play of the day. It's a fund of the biggest oil conglomerates, plus a smattering of oil equipment makers, drillers, refiners, and storage providers. Its biggest holdings are Exxon, Chevron, and ConocoPhillips. And those three stocks actually constitute about 50% of the fund. So it is pretty top heavy, but it has a good bit of different kinds of energy stocks in it. And as you can see on the chart, energy stocks aren't doing too hot lately. That's the rough shape of the sector for you. They could continue to rally on the back of oil, and it's anybody's guess what oil is going to do next. So overall, we're feeling a little cautious on the sector. It's run far. It might need a break. The financials don't look great, but there could be some more upside depending on what crude does. That in itself wouldn't be the biggest surprise to us. Crude is close to eclipsing its 7-year high that was reached in October 2018. And if inflationary pressures continue, yes, I said the I word, inflation, oil could climb even higher. So put it all together, Brian, and I want to hear what you're thinking in XLE options. But before I pass it to you, as always, please, please, please put your questions in the chat because Brian and I will be answering your questions live at the end of the show. So give us some good ones. All right, Brian, what are you seeing?
All right, so we're going to approach this as a FOMO trade. A lot of times when we're talking about a lot of these ETFs, I like to look at just buying a deeper in the money call as an alternative to buying that ETF outright. So inside the options playbook, optionsplaybook.com, excuse me, we actually highlight the strategy in the rookies corner, and we just say buying leaps as a substitute for buying stock. Now, leaps is just a fancy term that means longer term options. It's a marketing ploy done by the Chicago Board Option Exchange, but it's really just longer dated options. Now, we're not going to go out more than 9 months in time, and that would be a legit leap. But the most important thing that you're going to read about if you read this little rookie corner section as buying a call option as a substitute for the stock is that we're going to go deeper in the money. We're going to buy some delta. We're going to buy an option contract that acts like the underlying stock, that gives you a lot of stock representation. Now, that's going to be a fairly expensive as relative to the options world, relative to buying an at the money or out of the money option contract. But because of that, you get what you pay for. When you buy a longer term option and you go deeper in the money, when the underlying stock moves, your option does move, and it moves almost as much as the underlying stock. And that's our goal here by doing a FOMO trade where we're going to limit our risk. As Callie said, we've had a big run up. We're a little bit trepidatious on where we're going to next. Maybe we could get a little pullback before we go higher. The crude oil prices, right now we see crude trading right around $73 a barrel or so. If we could get that up to over $80 a barrel, it's been a long time since it's been in that range, but that was a very popular range back in the day for a barrel of crude oil overall. So with that said, how can we use options to reduce our risk on the downside, but still give us some upside if we can continue to see this move up in crude? And how we're going to do that is we're going to go to the Ally Invest option chains. We see that the XLE is basically flat today, up 5 cents. We're going to go out to the end of the year. We're going to go out to the December 17th expiration, which is 171 days away. Now, ideally, you could go out to January if you just want to look at an option contract that will expire in 2022. That's feasible, but I'm going to stick right here with the January 17th, the normal monthly expiration, 171 days to that expiration. Now, on our chains on the left-hand side, we actually have a call. On the right-hand side, we have the puts. So I'm going to focus on the delta here. So if I look at the 47 strike option or 47 strike December 17th option, we see that it has a delta of 78, almost 80, right? I would like it to be 80, but we're a few cents away from that. And one of the things that Callie did mention that is very important if you want to implement this strategy is that this is a very heavily traded ETF. And heavily traded stocks usually mean that you have better option markets overall. If it wasn't for the width of the spread in the options marketplace on longer term in the money option contracts, this would be a very interesting strategy on almost all underlines. But if the underline's not very liquid, it's hard to buy a leap option and get a decent buy a leap option considering that they have such wide bid-ask spreads. So I'm going to highlight that. The bid on this option contract is $8. The ask is $8.15. Fairly decent marketplace. We have a little bit of open interest and no volume today overall, but we still have a fairly decent tight market on the actual option contract that we're looking to trade. So I'm going to check this box over here. If I click once, it puts a buy, puts that option strategy down in our option strategy workbench. You can try to work this option contract, but there's no volume today. So ideally, you're really going to be paying that ask, which is $8.15. Now, here's the issue. If we turned around, bought it and said, oh, I guess I don't want to buy this option contract, and I sold, I'd already lose 15 cents on that trade. And that's what we mean by that bid-ask spread and dealing with that situation. If you're buying the underlying stock, it's a 1 cent spread overall. But here's the benefit. Okay, I'm going to make this trade in the right rail. That becomes the official paper trade for today. And once again, we emphasize that this is just a paper trade. We're trying to learn here on Options Playbook Radio, and a lot of things. On the stock play of the day, and a lot of the things that we do on the show, as far as option strategies are concerned, is we look at the marketplace and we say, how can we use options to make the situation better? How can I manage some risk to the downside? How can I benefit to the upside a little bit more than if we just bought the stock outright? And if we buy this option contract and we pay that $8.15, the December 17th 47 strike call option, if we pay the ask for this trade, we might try to work it, but if we pay that, that means we have $815 of total risk. That's around 15% of the stock price if we were to buy 100 shares of stock. So we see the stock right now is trading at $53.55. I'm going to highlight that up on the top of my screen here. So you're talking about $5,356 if you were to buy that outright. Our total risk here is $8.15. That's about 15%. Now, you might say to yourself, well, it's still 15%. I don't want to lose 15% on any underlying overall. Here's one of the nice things about buying in the money leap options as opposed to buying the stock outright, or in general, buying an out of the money option contract, is that if I'm in the money and the market goes up, it actually acts more and more like the stock. The delta increases as the underlying goes up, rewarding me more if I'm correct on my forecast. Now, if the underlying goes down, the delta actually gets smaller. That means we lose acceleration to the downside. And for example here, I'm going to kind of highlight this, is let me go back to the chains. We'll make that the official paper trade. I'm going to close that out right now. Okay, so let me go back to the chain. And if the underlying market goes down to our strike, our 47 strike call option here, I would consider getting out. So it gives me my effective stop point, if you will, if I'm incorrect on my forecast. And why do I want to get out if the market gets down to about that 47 range? The reason why is that's where a lot of the time premium sits on the most at the money option contract. So I'm going to do something real quick, and this isn't an exact formula, but I think this is important in learning why you might want to do a leap option as opposed to buying the stock outright. So stock's at 43.57. Let's look at the 54 strike option contract. It's about 40 cents approximately out of the money. Well, if we put this trade on today and all of a sudden the market just took a nosedive and went to 47, guess what? That would be the at the money option contract. What's the at the money option contract trading for right now? Right around $4. We're paying about $8, right? So that means that if the market did go down and it moved down from that 7 points to the downside, right now it looks like we're going to be losing about half of our investment. But if it moved to the upside and say did 7 points, which would be the same type of move to the upside, well, let me add a couple of strikes. I guess I'm going down that road, right? But if I add a few strikes to the upside, you see that on the upside, as it gets deeper in the money, this in the money option contract, oh, I need to go to the downside, my bad, is going to actually reward me more. So as I go up, I actually increase in value exponentially as I get deeper and deeper in the money if that market were to go to the upside. So interesting scenario. That's why we like to build this as the FOMO trade. When we're looking at industries that we think could go higher overall and a little bit more longer term, but we don't necessarily want to dip our toe in the water because they've already made a big run up overall. So how can we manage our risk? We go a little bit deeper in the money. We make sure we have a liquid marketplace. We buy a lot of delta, and then we see what the stock does from that point going on. Fear of missing out, FOMO. That's how I define that overall. All right, Callie. Got a little bit long-winded, but anything in the chat box? Please put your questions in the chat box right now. We'll try to answer them live on this show.
Yeah, Brian. Well, I'm going to echo what Brian said. Please, please, please put your questions in the chat. I know you have questions about energy stocks. I have a bunch myself. So maybe we can figure them out together. All right, so I see one question in the chat, and this question is from Akeem Bethel. Hey, Akeem. Akeem asks, what do you feel is a good entry point for XLE? And I'm actually going to punt on this and send it to Brian because thinking about XLE, I mentioned energy stocks are really tough to gauge financially right now. So, this could be more of a technical question. So, what do you think, Brian?
Well, okay, so I guess I'll show the chart that we have, and I'll be blunt on the chart. It doesn't really look too exciting. It's not really showing us anything that interesting. In that we did have this breakout from back in March where we actually did break to the upside, but it didn't hold. So this was interesting if we would have continued that break, but it didn't happen. So I guess we'll just focus on the 20-day or the 50-day moving average. So we're kind of channeling here, having a tough time breaking out to the 20-day, breaking out to new highs. But on the downside, we're seeing the 50-day. So right around in here, I think the 50-day could provide some support to the downside overall. Obviously, the range right down here where we had a lot of consolidation, right around the 51.35 level. But once again, we're managing our risk using the option strategy. So what we're looking at for a paper trade today is just buying it where it's at right now. The chart isn't that exciting. It's not gleaming a ton of information overall, but we definitely, if we get another breakout to this upside here, that would overall be a strong move in the marketplace. And ideally, you might even want to look at what's going on with crude, because obviously this ETF tracks the price of crude a lot, especially recently, considering the strong move in crude to the upside, which has also conveyed a strong move to the upside in the XLE. All right, any more?
Yeah, definitely. Good answer, Brian. I like that one. All right, here's a good one. So this is from William Mitchell. Hey, William. William asks, do you ever use unusual activity of options volumes to select an equity, to select an opportunity in the options market? I know this is what a lot of people are wondering. So, Brian, thoughts on looking at unusual options volume?
Yeah, and I do think that it's worth looking at. Obviously, there are some analysts out there that have made a business just off of talking about unusual option activity. So all you're doing is trying to follow the money. And when we speak about that, the options marketplace, the reason why it's interesting is that the options marketplace is much more transparent than the stock marketplace. When you see volume coming in the stock marketplace, it's really hard to discern exactly what that person is thinking when they come to the marketplace. And that's the biggest challenge probably of unusual option activity is seeing, okay, somebody came in, they bought this option contract, they were willing to pay the ask, they drove up the price and they bought more. Okay, so if that was a call option, some people might think that yes, because of this, they're spending big money. Big money is usually smart money. So I'm going to follow that overall. Now, obviously, not every most people are not all knowing, so they don't necessarily know where the stock is going. But that's the concept behind it. In the stock world, it's really hard to discern when that order came in, what that person was looking at. So, is unusual option volume a thing? Yeah, it is. People do like to track it and they like to follow it. And they're just the biggest assumption of unusual option volume is that the people that have money, the big traders, know what they're doing. In other words, you're trusting their outlook on the marketplace overall. So if you feel comfortable with that, you can look into unusual option volume. And I actually I have a lot of reporters that will give me a call and I will, discuss what I think actually happened by looking at the volume. And it all can happen mainly because you know that calls are usually bullish if you see them being bought. You see puts are usually bearish if you see them being bought. And so with that said, you can kind of discern what that trader was thinking when that order came to the floor.
Good answer. Good answer. And as somebody who used to cover unusual options volume and who was a reporter actually calling Brian, I definitely agree. It's something that you watch, and the options market does have some great transparency. It's a little bit easier to put the clues together and really see what somebody's thinking. All right, another question. This one from a longtime caller, Wayne. Hey, Wayne. Wayne asks, Brian, I have a challenging question today, and it's challenging. Brian.
Bring it on, Wayne. Bring it on. I'm ready.
We asked for questions. We got a question. All right. So Wayne asks, Can you explain why gamma increases much more around 21 days and under and impacts the delta so much more?
Okay, so gamma is the rate of change of delta. It's the acceleration factor. Now, if you look at delta, there is a great section in the options playbook, by the way, called the Greeks. It's very well read. Actually, we track what people are reading inside the options playbook, and that is one of the most read pages. It's called Meet the Greeks. I'm going to highlight it here right now. But if you want the definition of gamma, gamma is acceleration. Delta is so interesting and such a big driver of focus that they gave it its own Greek. So it's the derivative of delta, tells you how fast delta will move. Why does it get faster as expiration approaches? Well, the easiest way to explain it is to say, if you think of delta as the probability that something will be in the money on expiration, right? That is the non-textbook definition, but it says, what is, if I look at that delta and I say that we have an 80 delta, which we were showing on our show today, that means we're deep in the money option contract. There's a high probability that that strike price will be at least 1 cent in the money, not profitable, but at least 1 cent in the money by expiration. Hence the reason why the delta increases. So as expiration approaches, what changes with that probability? If I am a point in the money with 1 day remaining, that probability is pretty high. And what happens to delta? It increases. What makes delta increase? Gamma does. Okay, so now this is getting a little bit above and beyond. If I'm 1 point out of the money with 1 day remaining, what's the probability of it finishing at least 1 cent in the money? Well, it's a lot lower. That means that delta decreases in a hurry. So gamma is that acceleration factor, and delta really moves as expiration approaches. Now, one thing about delta is it can't get above 1 and it can't go below 0. So on the tails, it's going to move slower just because it can't. Option is a derivative. So that means that it's derived from an underlying price. If the stock goes up 1, in theory, in the theoretical pricing world, the option contract can't go up more than what the price it is derived from. So the biggest delta can get is 1 on the upside, and the lowest that it can get is 0. And so gamma is going to, that acceleration factor is much higher in the week prior to expiration as that option contract goes in and out of the money and as those probabilities change overall. If you want to learn more, if that was above and beyond, check out Meet the Greeks. And I do have some videos inside our community that address the Greeks and option pricing in general.
All right. Talked a little bit of gamma. Wow, that was a tough question.
Well, yeah, it is.
Yeah, Brian's brain is kind of throbbing right now.
Well, we can come back at some point in time and talk a little bit why we might care, but that's part of the reason why a lot of people don't like to sell weekly options, weekly option spreads, because the market goes against you, it goes against you fast. And we've talked about this on the show where we've looked at doing short call spreads, short put spreads, and we go 45 days out, mainly because then it gives us a time to adjust it. And that time premium protects us if we are incorrect on our forecast and the market goes against us. That's where it really plays out.
All right. So I have one more question. We'll call this a speed round. This question is from Chow Main. Hey, Chow Main. Chow Main asks, what happens to open short positions when two companies merge? Let's say company A and company B deal to become company C. All right, Brian, you want to take this one or?
Yeah, we can. But there's no general answer to that because every merger is different. But I can reference you to the OCC, which is the Options Clearing Corporation website. And they always put up a white paper or a PDF that explains what that new option contract is going to be. So if it's part, say the merger's done part stock, part cash, well, then it gets a little bit complicated. But bottom line is the terms and conditions of the option contract need to represent the same amount of value as before the merger. So they're trying to get all that together. Sometimes they put cash in lieu in. I think the biggest thing to understand overall, and this is different with splits, but if we're looking at mergers, you really don't want to be in an option contract that is a, a combination of these two different companies that merged. So if I was in an option and it was going into that merger, I would probably want to get out of the option, only because the liquidity factor does happen after the fact. Once they become a new company and it trades under, let's say, one of the stock symbols, well, they're going to open up new option contracts, and they're going to be ordinary option contracts. And that's what the people are going to trade. They're not going to want to trade this oddball option contract that they all put together before the merger. So the lesson here is you don't know necessarily what's going to happen. You're going to have the same value overall. The actual price of the option contract really shouldn't change as long as the stock prices stay where they're at. But bottom line is liquidity does. More people, as that merger completes, are going to want to trade the new option contracts that they're opening up. And because of that, you might see wider bid-ask spreads in your option contract that you rode through the merger with.
Yeah, and I'll add on there too. If you're short stock, a lot of what Brian says applies to. You have to remember that the value still needs to be there, and there is a risk of being margin called because when you're selling stock short, you're borrowing the shares from somebody else and selling them into the open marketplace. But when a merger happens, when an acquisition happens, the company or some other investor is looking for that stock back, so there's a higher chance of a margin call. All right. And with that, I'm going to go ahead and wrap it up. Thank you for joining us, everybody. Brian, I actually don't know if you're having stock play of the day overtime on Friday. So I'll let you talk us through that.
Yeah, we will be. We'll be doing the stock play of the day overtime this Friday. It'll be at noon Eastern time. We'll talk a little bit about this trade that we had going on in the XLE. And then we will be back next Tuesday, the 6th. So mark it on your calendar. We will be back the day after the market closed on the 5th for the next stock play of the day. So if you don't want to write all this down on your calendar, you know what you can do? You can just click subscribe and you can ring the bell and you'll get all the notifications for all of the stock plays of the day. Thanks for coming, everyone.